This presentation consists on analyzing Starbucks Corporation regarding its main financial statements, ratios, and overall data. We collected this information by using the Bloomberg Terminal and Economatica. We analyzed different financial statements and graphic financials from Starbucks and its four main competitors, which they are McDonald's Corporation, Restaurant Brands International, Yum Brands, and Dunkin' Brands. The objective is to conclude if a shareholder should invest or not in Starbucks.
In a brief history, Starbucks' motto is to share a great coffee with your friends and help them make the world a little better. It was founded in Seattle and it was based on Italian coffee shops. Starbucks is the world's leading coffee chain, and its concept is known by them as a competitive advantage. On the ownership structure, we see that 74.77% is owned by five large groups: the Vanguard Group, BlackRock Corporations, State Street Corp, Morgan Stanley, and Magellan Asset Management. Starbucks operations are mostly company operated. Although they sell the brand's rights for individuals that want to have a Starbucks, they do not sell the franchisee model. On main competitors, we have Dunkin' Brands, the owner of Dunkin' Donuts, McDonald's, the owner of McCafe, Restaurant Brands International, the owner of Tim Hortons, and Yum Brands, that although they do not have a coffee on command, they are one of the biggest restaurant producers in the Bloomberg analysis. McDonald's is considered the largest chain in the United States. Yum Brands, one of the largest fast food restaurants in the world, is the owner of KFC, Pizza Hut, and Taco Bell. Dunkin' Brands is present in 35 countries and is the owner of Dunkin' Donuts, Baskin Robbins, Mr. Donut, and Mr. Donuts. And Restaurant Brands International, owned by George Paulo Lemann, is the largest in Canada and was founded in 2014 and the owner of Burger King, Tim Hortons, and Popeyes. On the financial analysis, we have the financial ratios. The return on assets, we see that Starbucks is higher than the competitors and ended 2017 at a 20.12%. Therefore, the company assets are better used than its competitors. On return on equity, we see that Starbucks is above the competitors. Its equity is being better allocated and therefore it is more profitable. On efficiency, we have the inventory turnover. Starbucks inventory turnover has been stable for the past 4 years, while the competitors' ratio increased. On receivables turnover, we see that Starbucks has a stable ratio, and it is higher than its competitors. And the profit margin, Starbucks has a lower margin. We believe that it's related to a higher fixed cost due to the ownership of most of its operation.
The total debt ratio measures the proportion of a company's assets that are financed by debt. The higher the number, the worse, meaning a greater financial risk. Since 2014, Starbucks has been better than its competitors as it had a lower number. Also, it remained pretty much constant. The competitors are getting close to the 100% mark, which is very alarming. The financial leverage ratio represents the extent to which a company uses fixed income securities. A higher figure is negatively perceived, as it means that the company is using more debt financing. Since 2014, Starbucks has been better than its competitors as it has a lower number. Also, it remained constant. The current ratio measures the company's current asset against their current liabilities. A higher figure represents a better situation, as this means that the amount of current assets is higher than the amount of current liabilities, and the company would pay its debts with more ease. Starbucks was in a better position than its competitors back in 2014, but they changed places and currently the competitors are way ahead than Starbucks. The quick ratio is the same as the current ratio. but with the difference that it excludes inventories from the current assets, focusing on most liquid assets. Starbucks have been behind and worse than its competitors, except from the year 2015, where it was a little ahead, but went back to being behind with the distance only increasing. This figure represents the ratio of cash and equivalents compared to current liabilities. It measures the ability of a company to pay its debts with cash and equivalents. Starbucks figures have always been behind and worse than the ones from its competitors in the period from 2014 until 2017. Besides that, we can see an increasing trend.
On the current ratio, we see that Starbucks' ratio is lower than its competitors. That indicates that it's harder for Starbucks to pay for its debt with cash. And quick ratio, it is also behind its competitors. The calculation only differentiates itself from the current ratio by excluding inventories and focusing on liquid assets. On the cash ratio, we see that Starbucks is behind its competitors, which indicates that Starbucks has a lower capacity of paying its debts with cash and cash equivalents. On the cash flow, we see a turning point after 2015, where Starbucks started showing positive signals of cash and cash equivalents after the year, and also an increase in dividends and payment of dividends per share. Now on the shareholder value creation. On dividends per share, we see an increase in the line, which indicates that Starbucks is paying more and more of dividends per share. It is a good signal for investors that want to have dividends. In the dividends payout ratio, we see the amount that is paid to the shareholders when related to the net income of the company. For Starbucks, it is also a number that has decreased to 2018, but we plan to have a higher number after this year. On the dividend yield, we see that Starbucks has been paying more of dividends each year when you make a relation with its share price. Therefore, even though the share price may be lower, they are paying more dividends to the shareholders. On working capital management, we see that the competitors are performing better than Starbucks. And net operating working capital, although Starbucks had a negative result in 2016, most of the results are positive since 2014 and now to 2017. On risk and return analysis, we see that Starbucks has an expected rate of return of 10.16. This is not a really high number, it's a really appropriate number for the share.
By comparing Starbucks with Dunkin' Brands, McDonald's Corporation, Restaurant Brands International, and Yum Brands, we saw that Starbucks presents better ratios on profitability and leverage. However, below competition efficiency and liquidity ratios. Now, taking into consideration the total debt ratio, we saw that since 2014, Starbucks has been better than its competitors and has remained pretty much constant, presenting low numbers, which is a good indicator for this ratio. This means that it offers a low financial risk. The data analyzed presents a positive constant growth concerning shareholder value creation. The dividend yield and dividends per share are both growing and reaching high and considerable values. The dividend payout ratio, despite presenting a reasonable drop, shows a great recovery, also reaching high values with time. Finally, from a shareholder point of view, we do recommend investing in Starbucks. Thank you.